Morning, guys. It's Monday, April 7th, 5:24 a.m. Central Time. We've got a lot going on in the markets. The stock market is sharply lower this morning. Crude oil sharply lower this morning. Grain markets actually kind of quiet by comparison. May corn futures down 1.25 at 4.59. May soybeans up 3/4 of a cent at 9.77 3/4. May Chicago wheat up 1 at 5.30. May Kansas City wheat up 3 at 5.60 1/2. May spring wheat is up 3/4 of a cent at 5.85 1/4. Let's start off with the soybean market, which fell sharply on Friday.
It sure did. Futures fell sharply on Friday after China announced retaliatory tariffs, declining by 3.4%, hitting their lowest level this year. The May 25 contract slid nearly 35 cents, closing at approximately 9.77 per bushel, the lowest price for a front month contract since mid-December. The market's reaction followed President Trump's announcement on Wednesday of a broad 10% tariff on all imports, along with reciprocal tariffs, which included a 34% tariff on Chinese goods. In response, China imposed its own 34% tariff on all U.S. imports early on Friday, adding to the 10 to 15% tariffs already imposed in March on $21 billion worth of U.S. agricultural goods. China's newly announced tariffs are set to begin this Thursday.
China came over the top on Friday morning with with this 34% across the board tariff, and I would assume that soybeans are included in that. So the soybean market fell sharply on Friday, and rightfully so. China, year in and year out, is the biggest buyer of U.S. soybeans on the export market, and exports this year are projected to account for 42% of all demand for U.S. soybeans. China has accounted for, to this point, 48% of all U.S. export commitments. That means that China roughly would account for 20% of all demand for soybeans grown in the United States. So yeah, the trade war and the tariffs are a huge deal for the soybean market. And that's why across the grain complex, you see the weakness in soybeans, and you're not really seeing it in corn, and you're not really seeing it in wheat. Soybeans are the ones that I think could be impacted the most. There are a couple different arguments out there. Some people might say, hey, China's already bought about what it's going to buy for this current marketing year, and therefore maybe the tariffs aren't that big of a deal. I don't necessarily agree with that, because we've still got some unshipped sales on the books. It's not a ton. It's like 30 million bushels, which grand scheme of things is not huge. But you've also got to remember that China would typically come in and start buying soybeans out of the U.S. for new crop delivery in spring or summer. And there is no degree of certainty with regard to how long this trade war lasts. It could be a week. It could be a year. I mean, it could be longer than a year. You don't know. And that's why the market is erring on the side of moving lower. May soybean futures fell below what I believe was some key support on Friday, that 991 level, which was a low from early March, I believe, that we kind of tested a couple times. We fell below that. So if you go back down and test that December low around 955 in the May contract, that would not be shocking to me. The November contract doesn't look good either. Lost almost 33 cents on Friday. The corn to soybean ratio posted some fresh lows on Friday and again overnight. You're 2.2 to 1, which is a level that would historically favor more corn acres in the United States and drastically more. We saw USDA's numbers there a couple weeks ago. I can't help but wonder if you see even more corn acres now, because the soybean situation for new crop delivery is just so incredibly unattractive to farmers. So the soybean market has bared the brunt of the selling. Corn futures have acted just fine. Wheat futures have acted just fine during this. It's really, as it relates to our complex, a soy complex thing for now.
Oil prices tumbled to a 4-year low last week due to President Trump's newly announced tariffs and OPEC Plus's decision to triple its originally planned production for May. WTI crude declined by 14% between Thursday and Friday, settling near $61 per barrel. Oil supply risks persist, however, as the Trump administration has threatened to intensify sanctions on oil-producing nations such as Iran and Venezuela. Analysts expect oil prices to remain volatile as long as recession risks remain elevated.
Yeah, so the trade is concerned that we're going straight into a recession, and that as a result, demand for crude oil and gasoline and products will decline. Overnight, we traded down to 58.95 in spot month WTI crude futures, which was the lowest trade since April of 2021. And in April of 2021, we were still kind of coming out of the COVID situation. So this is not a good place to be. At risk of sounding political, and I don't mean to be political here, a lot of people have said that the tariffs are going to be inflationary, and maybe they will be to some degree on imported goods, especially. But this right here, crude oil dropping to its lowest level since April of 21, that is not inflationary. It's deflationary. The fact that you're going to end up with lower fuel prices in the United States and around the world, and lower commodity prices just in general are deflationary. And what we've seen is selling across most commodity markets, not all commodity markets, but a lot of them. And you got to remember that commodities are the first link in the chain for a lot of production, a lot of manufacturing, depending on what it is, of course. But this downturn in commodity prices as a result of the tariff situation is the opposite of inflationary. Now, there are other aspects that are or may be inflationary as it relates to tariffs. This is not one of them.
The S&P 500 suffered a historic sell-off last week following the announcement of new tariffs. The benchmark index declined by more than 10% over Thursday and Friday, marking one of the worst two-day declines in more than 70 years. Analysts say the sharp decline is being fueled more by market sentiment and speculation than by underlying economic data. Despite the turbulence, Fed Chair Jerome Powell stated on Friday that the Fed is in no hurry to cut interest rates. Some analysts believe the market is positioned for a short-term rebound. However, any recovery is likely to be limited unless there is a significant policy shift, such as a rollback of the proposed tariffs.
Okay, so this has turned into a 3-day sell-off because futures are sharply lower this morning. The S&P was down, I believe, almost 5% at one point overnight. It's down about 3% ballparkish, moving around quite a bit as I speak here. But that would be would have been Wednesday's close last week to the overnight lows, a 15.4% drop in 3 trading sessions. It very, very, very rarely gets much uglier than that over the course of 3 days. Of course, we've got concern about recession and all of those things. And you've just got, a nasty correction. We'd gone a while without a big correction in the S&P. I've had this kind of channel, if you guys are watching, on my S&P 500 chart for months. I mean, probably dating back like 2 years ago. So if you draw a trend line from the COVID low in 2020 up through your 2022 bear market low, your trend support comes in around 47, 46 in the S&P, and we could very easily be trading below 5,000 this morning. So to go down and tag that trend line would not be shocking at all. One other thing I wanted to show you guys was this. Interest rates have fallen sharply as a result of all of this. And why is that? Well, when investors are worried about the stock market, what do? They buy bonds because bonds provide some relative safety. You get a guaranteed level of return. And when the bond market rallies, which it has sharply, or in this case, the treasury notes, the interest rates fall. So you've seen a big decline in interest rates. And some people think Trump is playing 4D chess, as they might say, and he wants to get the interest rates down, and this is his way of doing it. I don't know that collapsing the stock market is the way to do it, but in any case, this has been part of the result of the tariffs.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about Friday's premium video?
Jim Uriel was on Friday, and we talked about what's going on in the markets, just generally speaking, more so like outside market stocks, interest rates, that sort of thing. Jim is a professional interest rate trader, has been for years. He is the perfect guy to walk us through exactly what's going on with the tariffs, and that's what he did on Friday. We took mailbag questions from subscribers. We talked about everything, stock market, interest rates, Jim's thoughts on the whole situation. It was really fantastic. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tried to sell you anything else. Just a ton of info direct from us every single business day. Friday's video was not a grain market video. We don't do grain markets every single day. We do grain markets most days, but we cover a lot of related topics that are of interest to our subscriber base. You can sign up on your phone, guys. It takes about 30 seconds. Give that deal a shot this morning.
Numerous countries have chosen not to retaliate against the U.S. following the announcement of new reciprocal tariffs. Taiwan, Vietnam, and India have expressed a willingness to negotiate trade deals with the U.S., either by reducing or eliminating existing tariffs. This development comes just days after President Trump announced reciprocal tariff rates of 32% on Taiwan, 46% on Vietnam, and 26% on India. Taiwan's president acknowledged that the new tariffs could pose serious challenges for his country's economy. Vietnam's willingness to negotiate may also encourage other nations such as Indonesia and Cambodia to join the discussions. On Sunday, a White House advisor reported that more than 50 countries had reached out to the White House to begin trade talks.
Yeah, that's what Bessent said. U.S. Treasury Secretary Scott Bessent said that more than 50 countries have approached the administration in efforts to bring down non-tariff barriers, reduce tariffs, and halt currency manipulation. I had thought for a second yesterday that maybe those comments from the White House would be like not so bearish to start the week, and that proved to not be true. I think this is just talk. There's no details, and what you need is details for the market to really express some degree of optimism. You're going to need a China to come out and say, yeah, we're going to walk this back and we want to talk. I mean, that's essentially, I think, what you'd really like to see here, and we're just not there yet.
The Midwest has received historical levels of rainfall in recent days. The storms, which began on Wednesday, have so far resulted in 16 confirmed fatalities. Officials have declared numerous flash flood emergencies from Texas to Ohio, threatening key infrastructure, roads, and bridges. Since Wednesday, parts of Kentucky have received over a foot of rainfall, while regions in Arkansas and Missouri have received more than 8 inches. Over 50 river locations across the Midwest and southern U.S. are currently experiencing or are forecasted to reach major flood stage in the coming days. Flooding across the region has the potential to cause shipping and supply chain delays.
So the rain totals were actually pretty close to what had been forecasted by those GFS models, which I had thought maybe were too aggressive. I think they missed by in some areas by a couple of inches, but actually pretty damn close. Here in my neighborhood, we had close to 9 inches of rain, I think, over the course of a 4-day period. I'm outside of Nashville, just kind of on the extreme east side of the super heavy stuff. If you guys are looking at this map, so I think that the rain and this excessive rain, I think it's a friendly input with regard to the grain markets. It's certainly now going to result in some degree of planting delays in these areas. These are areas in the southern part of the Corn Belt that would be planting corn or soybeans. I know some guys do soybeans first now. They would be planting. I think there's also going to be some damage to winter wheat crops in these areas. Moving forward, there's not much in the forecast the next 7 days, so all this stuff is behind us. The wheat market trades higher this morning, or did. It's kind of mixed right now, but I think that could be part of it. And also, you've got no rain in the forecast for HRW wheat country in the southern plains, which could also be problematic.
The funds increased their net long position in the corn market last week. CFTC released weekly commitment of traders data on Friday. During the week ending Tuesday, April 1st, large money managers were net buyers of 55,000 corn contracts. This is the first time since the second week of February that the funds were net buyers of the corn market. The funds were also net buyers of 30,000 soybean contracts and net sellers of 10,000 contracts of SRW wheat on the week.
I'm telling you guys, the corn market still has a story. I had a video out for our premium crowd a couple weeks ago about how tight the corn situation is. It was a short video. It was like 9 charts on why corn is tight. And it was global stuff, US stuff, all sorts of stuff. There's a reason the funds are still long corn. I know this is going to look different in real time, of course, because it's accurate as of last Tuesday, but the funds are still holding on to a fairly substantial net long position in the corn market. Soybeans, obviously, funds are net short and have very clearly added to it over the last few days. Wheat funds continue to stay short, as has been the case. If you look at corn, they did this whole kind of round trip where they were record short in July of last year, went to a very heavy net long earlier this year, and now they're kind of back to a more modest net long. Cattle market took it on the chin last week.
Yes, it was an ugly day on Friday. Live cattle saw losses ranging from 532 to 650. Feeders were down anywhere from 597 to the contract limit of 825. The only feeder cattle contract months that weren't limit down were front month April and March, and the March 26 contract. Cash cattle trade was steady to lower last week. In the Southern Plains, cattle were $1 to $2 lower compared to the prior week at 208. Up here in Nebraska, cattle were $3 lower at 210. And then over in the Western Corn Belt, cattle were steady at 213. Box beef was mostly unchanged on Friday. Choice was 8 cents higher at 338.45, and select was down 66 cents at 317.18.
Stock market is rallying back as I speak, and the Dow is still down 700. The Dow was down like 1,500 points at one point overnight. It's down. Dow futures are down 700. S&P futures down 86. Bonds are down. U.S. dollars down just a little bit. Crude oil is down $1.70. The May WTI at 60.28, which is more than $1 removed from the overnight lows. Have a great day, guys. We'll be back on Tuesday.